I'd love to talk to you.
Absolutely.
He
could send you the video of this so you can get it. Yeah, because there's a lot of good stuff in here.
Okay, so yeah, we're running a short video on Facebook Live.
Rotate your phone. Okay, wait. Is this going?
Yeah.
Oh.
We good?
It only goes this way, right?
Yeah.
Okay.
All right, so thank you guys for being a part of this. I know we started late, so I'm just going to jump right into it. Today we'll be talking about some tax tips for realtors or agents and investors. So in this presentation, it's actually usually split either one or the other. And today we're actually going to do it both because most agents that I know actually do invest in real estate. And so, we'll go through that. And feel free to ask any questions or anything throughout. This is more of a discussion as opposed to a presentation. So our agenda today, I'll give you an introduction of who I am and essentially why is it that I do what I do. We'll talk about setting yourself up for asset protection, so making sure your legal structure is set up correctly. And then we'll talk about taxes, which I'm sure is what you guys came here for. Learning more about taxes for investors, agents, all that good stuff. And then also one thing to note is every slide will have specifically what group of individuals the slide is tailored towards. So you'll see one for agents, you'll see one for investors, and then there'll be some slides that have both agents and investors. And then we'll go through how to keep track of all of this. So QuickBooks is our recommended software. And then throughout you can ask any questions or anything you want. So who am I? My name is Jeff Badu. I'm a licensed certified public accountant. And I graduated from the University of Illinois at Urbana-Champaign, got a bachelor's and a master's degree. One thing that's not on the slide is my purpose in life, which is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle. The reason why I do what I do is because let's just say I took a trip when I was 16 years old to Ghana, which is where I'm originally from, and seen a lot of struggle. And that was the first-hand view of that I need to do something about finances. I need to do something when it comes to a person's personal finances. So that's when I discovered my purpose in life, and just went through the journey, went through college, all that good stuff, was building a business plan. And today I'm a parallel entrepreneur, so I run multiple businesses simultaneously. There are 11 companies in the Badu Enterprises. And I'm also what's called a wealth multiplier. So I help people multiply wealth in infinite ways. So founder and CEO of Badu Enterprises LLC, which is a multinational conglomerate in the finance industry. We have close to 100 people in the organization currently. And the two companies mainly are Badu Tax Services, which is the company that's hosting or part of this presentation today. It's a tax firm that does tax preparation, planning, and representation for individuals and businesses. We're currently in all 50 states, and we have clients in about 10 countries at the moment. We also own Badu Investments, which is a real estate investment company, as well as a car rental company as well, but it's primarily a real estate investment company. We do multifamily units on the south side of Chicago, so we do 2 flats, 3 flats, and we purchase bigger units as well, 10, 30 units. Right now, our focus level is on the 10 and 30 unit market. And so we're in the process of acquiring those on the south side of Chicago. So that's my investment company. Sometimes I invite other people into the company to be a part of it, to be partners or to be investors in it or lenders even. And the reason why I'm really here today is I'm very passionate when it comes to financial literacy. It's teaching people about money. You might see me on the radio on 98.3 FM every Monday night from 7 to 8 Central. And I'm just talking about financial literacy. Last night I talked about how to maximize your tax refund if you are due a tax refund. So it's something I'm very passionate about. We help clients tremendously. Ironically, our main client base are real estate agents. So that's who we target. That's our niche market. And then we also target a lot of investors too, because the agents usually bring their investors, and we help them with items like that. So now let's go into the meat of the presentation, which is really incorporation. So making sure that you're incorporated. Now, I know a few of you in here have LLCs and S-Corps and things of that nature, so I'll explain to you what all that even means. So as a realtor or an investor, you have to be incorporated. No, you should never own a piece of real estate unless it's an LLC. You should never own real estate in your personal name. Even the real estate that you own personally should be in the form of a trust. But if it's business related, so if you have a rental property, even if you're doing house hacking or anything, LLC is usually the way to go. So there's only two legal types of entities in the world actually. If you think about it. It's the LLC, the limited liability company, and a corporation. With a corporation, you can be an S corporation, or you can be a C corporation. And I'll explain to you the difference between the two when we get to the tax. Or actually later on in these slides. But essentially with the reason why we get incorporated is to enhance credibility. So we need to, when we're presenting ourselves, so if let's just say that we are real estate investors and we're looking to attract investors on our team, maybe for capital reasons, family, friends, whoever it is. They're probably going to take you a little more serious if you have an LLC behind your name. If you're doing things in your personal name, then they're not really going to take it that serious. They'll think you won't know what you're doing. Even lenders, when they look at you, they're like, well, I mean, if you don't have a business, you don't have anything, you're just operating your personal name. So the credibility aspect is very important. All of my companies today are limited liability companies, or LLCs. I don't do business with anybody unless there's an LLC involved in some way, shape, or form. So the credibility is very important. Number one reason though is to protect your personal assets. So if somebody sues you and you own something in an LLC or corporation, assuming you haven't been doing what's called piercing the corporate veil or anything like that, essentially, if they sue you and they win a lawsuit, they cannot get a hold of what you own personally. So it's very important to protect your personal assets. And that's the number one reason why we set up entities. It's not because of taxes. The number one reason why we set up entities is to help protect our personal assets. And then last but not least, easier access to capital. When we're going to the banks, they do require us to have LLC or corporation. If you don't, they won't take you serious. They're like, well, I mean, if they can't even figure out how to get incorporated, how in the world are they going to figure out how to use the money that I'm about to give them? So most banks, all banks that I know require you to have some sort of entity in order to get a business loan to grow your business. Now let's talk about taxes a little bit. So all realtors, if you do real estate, if you're an agent, managing broker, whatever it is that you're actively selling real estate or buying real estate for other people, you have to be an S corporation. It's without a doubt. Now, the thing with an LLC is you can be taxed as an S corporation, but there is a law in the state of Illinois. Last I checked with my attorney, there's a law in the state of Illinois that basically, in a way, does not necessarily allow you to take commissions directly in an LLC. There have been talks of them changing the law, and I believe they actually did effectively change it. But in a way, if you're an agent, you do have to consult with an attorney first and foremost to see if the LLC is something that you're legally able to do. Because corporations are a little more high maintenance. You know, LLCs are very easy to set up. It costs $150 to set up with the Secretary of State. They are very low maintenance. You don't have to have board meetings. You don't have to have stockholder certificates. You don't have to have all these things that a corporation has to have. So it's very, very easy to set up an LLC and a low maintenance component. So I would say that if I'm a business, right, if I'm a realtor, if I'm an agent, somebody who's actively doing business, then I'm going to try to set up an LLC, but I can elect for it to be taxed as an S corp. So an S corp is nothing more than a tax status. It's not actually a legal status. It's simply a tax status. Because there's only two legal statuses. There's LLC and then there's a corporation. So if you're a realtor, you have to look into the S corp. Whether you're doing a corporation taxed as an S corp or an LLC taxed as an S corp, you should be an S corp. The number one reason, can anybody figure out? I got a giveaway really quick. First person to figure out why you should have an S corp as a real estate agent, it's a free copy.
Tax
Any volunteers?
Paying your taxes.
Because you could use your salary and then the depreciation and write it off and have a paper loss.
When I'm looking for a keyword, there's a keyword that you can save. There's one thing you can save by an S corp that nobody else, no other entity type can save.
Oh, it's a law, isn't it?
I'll take a guess. I'll give you a hint. Nobody wants to pay it.
Income tax?
That's part of it. You definitely have to pay income tax. But there's one tax that nobody wants to pay because it's probably not going to be around about 30 years.
Social Security. Go ahead, I already have it.
So that's a book I actually wrote on real estate. Pretty much, it's called The Legendary Asset. 6 reasons why you should own real estate. I work with a lot of millennials. And as we know, millennials aren't the best when it comes to home buying. So I'm like, you know what? Why not make it sound really attractive and not just home buying, but do some sort of house hacking strategies to start off your real estate and then perhaps move into a BRRRR or buy, rent, or buy, rehab, rent, repeat, all that good, refinance and repeat. Or like your second property be a 10 to 30 unit, just like what we're doing right now. So that book was written to encourage folks such as millennials to get into real estate, but as an investment, not just personal. If you have the opportunity to use an FHA loan and get 3.5% down payment and live in one unit, rent out the other units, that's a beautiful strategy right there. An average individual, your biggest cost is housing. So why is it that you can wipe out your housing costs and still be able to invest and have somebody else pay off your student loans? We know student loans tend to be the second biggest issue for millennials. For some, it's the first big issue. But to me, I think the biggest issue for millennials right now is home ownership. There's just a lack of home ownership when it comes to millennials. So the number one reason why we set up an S corp is to save on self-employment tax, or FICA, or Social Security, the word we all hate. So me personally, all my active companies, so I own a tax firm, a life insurance agency, we do some property tax appeals. There's a lot of active businesses. I'm not the CEO of all the companies. As a matter of fact, my fiance is the CEO of my life insurance, the agency that we run. So all those active companies are going to be taxed as S corps because we don't have to pay FICA or self-employment tax. We can declare a low salary, perhaps 25% of our profits, and then 75% does not get subject to FICA. You still have to pay income tax. So the way it goes is, if you made $100,000 profit throughout the year, you still have to pay income tax no matter what, right? So $100,000, you pay it at your regular income tax rate. Let's just say 25%. Actually, let's not confuse the numbers. Let's just say that if you're paying $100,000, you're going to be in a 22% bracket, right? So you're still going to be paying that. But if you instead of paying 15% FICA on $100,000, so if you're taxed as a single member LLC or a sole proprietorship, then you're going to have to pay an extra 15% FICA tax on $100,000. Nobody wants to do that. Trust me, I know nobody in this room wants to pay more taxes than they need to. You guys want to buy real estate. You guys want to help your families. Nobody in this room wants to pay extra 15% that you know for a fact is probably not going to come back to you. Some of it might, but for me, by the time I retire, according to the traditional definition, at age 67 or by the age 70 when I retire, it's not going to be there. I'm going to have to fight the government for the Social Security money. That's for sure. But essentially, to avoid paying an extra $15,000 on taxes, we basically convert to an S corp, and we don't save the full 15 because remember, we have to pay a salary called reasonable compensation. The IRS requires us to pay a salary, and for my clients, we usually do 25% of profits. So your salary would be $25,000, but your distributions or your profit that's not subject to FICA will be $75,000. So you're saving 15% on $75,000, which is a pretty massive savings. Our number one service in the firm right now is tax planning. And that's where we pretty much hit it home with our clients. Like, hey, our ideal client is an agent who is a single member LLC or doesn't have an entity at all. Like, those are the clients we target because we can truly help them by saving this extra 15% FICA tax. So that's the S corp. Now, LLC, why you should put your real estate in LLC? With a corporation, there's a thing called built-in capital gains taxes. So if you have a corporation and you own a property and you sell it, or let's say you transfer ownership or you refinance or do whatever, you can get trapped in what's called built-in capital gains taxes. So we always own real estate in LLCs, always, no matter what. Always, always, always own real estate in your LLC. If it's, I'm talking about the physical real estate property. To avoid the built-in the built-in capital gains tax. And if you're an investor, you're not subject to FICA tax. So if you do rentals and all that, there is no FICA tax. That's why we don't need an S corp for making money on real estate. Can anybody guess what you should be paying your effective tax rate as a real estate investor? Anybody take a wild guess what you should be paying as a real estate investor? Anybody? 0%. Yeah, as a real estate investor, you should never, ever, ever have to pay income taxes. Ever. If you're using the right strategies. And we'll go into that in a second. I'm sure that's what you guys came on here for. So taking it, any questions on the entities, by the way? S corps and LLCs and all that good stuff?
If I have, I moved out of my condo and it became an investment property.
Mhm.
Now, how do I go about putting it into an LLC? Because it was my primary residence before.
Yeah, so you do what's called a quitclaim deed,
Mm-hmm.
where you're transferring the beneficial ownership of the property to the LLC.
Okay.
And this is where an attorney would come in. But basically, the attorney would draft up the quitclaim deed document. It looks something like, hey, I'm transferring my beneficial ownership from myself to my LLC. And you'll usually say, in consideration for $10. You always have to have something you exchange. So it'll be like a $10. You have to make sure the water bill is paid. There's no outstanding liens or anything like that. And then they'll do the quitclaim deed and you close on it. It's nothing hard. You just got to get a few documents.
So you got to set up the LLC first.
Yes, you do.
Okay.
Now, one thing you might want to do though, and I'm glad we're on this slide, is a land trust. Great for real estate investors. So I mentioned that all real estate should be owned or held in an LLC. But let's take it a step further. If you can, you don't have to do this, but if you can, go through a land trust. It's not that expensive to set up, but with the land trust, it adds an extra layer of protection. So extra layer of asset protection.
Is that assuming that your property is paid off and you free and clear own it? Because if you've got a mortgage through a bank and you want to put it into an LLC, do you have to change the mortgage?
No,
I
you're
think your
not.
mortgage your lender has to approve it.
Right. As long as your lender's okay with it, and I can tell you, every single lender I've talked to is okay with it.
Okay.
Right? Because you're still on the hook on the loan. So as long as you're on the hook on the loan, if you run off to Vegas, Ghana, wherever you go, the building is still here. They can come after it. However, if it's in a land trust, they usually cannot come after the building. Because a land trust adds an extra layer of protection. And there are lenders that let you close in a land trust. Definitely commercial lenders will let you close in a land trust. Residential, you definitely have to ask them and say, hey, I want asset protection, this extra layer of protection. I attended this presentation, and I want to put my property in a land trust. So you can go ahead and do it in a land trust, and it adds an extra layer of protection. It also adds privacy. So if your property is owned by a land trust, nobody's going to know who owns it. It's going to go a little something like this. Chicago Title Land Trust number 1, 2, 3, 4, 5, 6, 7, 8. It's not going to say Nicole. It's not going to say Jen. It's not going to say anybody other than the land trust title company. So nobody is going to know where you live. Nobody knows what you own because it has that privacy measure, right? And then it's also good for transferring wealth from generation to generation because you don't go through probate. There's no probate when you have a trust because the trust has the beneficiaries in there, right? So it's ideal to own real estate by the land trust and then make the LLC the beneficiary of the land trust. That's how it works. The reason why we do this is because it creates inside and outside protection. If somebody sues an LLC, they can still take what's in the LLC, which is the building, right? And it goes a little something like this. A tenant slips and falls, busts their head, and they say you didn't provide a stable environment. They go to court with you, they sue you, all that stuff. So they can, if they win a lawsuit, they might not be able to take what you own outside of the LLC unless you're piercing the corporate veil. So you're doing things like accepting checks in your personal name. That's a big no-no. You're paying bills with your personal name. So that creates what's called the inside protection. what's inside the LLC, meaning that, so outside protection. So the LLC creates outside protection, meaning that nobody can sue you and take anything outside. But if you have a land trust, guess what? They can't sue the land trust because in the state of Illinois, you cannot attach a judgment to a land trust. So if they sue you and they win the property, they don't win the property because you cannot sue a property. You cannot sue a land trust. So it provides inside and outside protection. So if you want to protect the property itself, it has to be in a land trust. So that's like asset protection to the maximum. You can't get any better than this. You know, land trust, LLC. So the way it goes, if you look at the chain of title, the land trust would be the main owner, the LLC would be the beneficiary, and then you would have a living trust that owns the LLC. And then after the living trust is you. And then you can put your kids, you can put your spouse, everybody in there as a beneficiary. You know, knock on wood, if you pass away or something bad happens, then one of the beneficiary gets it, whoever you name as your secondary beneficiary. So while you live, you're going to be the beneficiary of your own trust. And you should have a living trust, so that's outside of the scope of real estate, but you should have a living trust because that helps you protect your personal, it helps you pass things down. Because if you don't have a trust, you have to go through probate. Anybody that's been through probate, family members, know it's not a fun process at all. I have clients that go through it all the time, and they wish they would, their parents or whoever passed away set up a trust. So you cannot attach a judgment to a land trust in the state of Illinois. In most other states, I believe Texas, love Texas by the way, one of the best asset protection states in the world. And we're actually thinking about relocating to Texas one of these days. But that's a story for another day. But so now let's talk a little bit about taxes, right? So why you should file, this is for realtors and investors. You have to file if you earn an income. If you earn more than $400 as a self-employed individual, you have to file an income tax return. If you don't, the IRS will send you a letter saying, why didn't you file? And then they'll give you about 30 to 90 days. And then if you don't file, they'll send you a bill saying you owe money. If you don't pay that, they can take you to, they can basically file a lien against your house, your car. Even if you owe them like $10,000, you know, and your house is worth $200,000, they can come and take possession of your home. So you have to be very careful with the IRS. At a bare minimum, just file. Even if you don't think you should file, just go ahead and file anyway. Even if it's a $1 return. I have a client who came to me. He was like, man, like I'm really scared of the IRS. I haven't made any money this year, but I want to file anyway. I'm like, well, let's file you a $1 return, you know, just to be safe. So you really want to be careful when it comes to taxes and the IRS. So everybody has to file, right? It helps you stay compliant with tax laws and regulations. You file annually, and then you do what's called quarterly estimated tax payments. If you made over $1,000 or more or so in profit, I would say with the estimated tax payments, just look at your profit each quarter and usually use about 20% for federal and then 5% for the state of Illinois when it comes to estimating. So look at, and then subtract out, make sure you're subtracting out any salaries that you're doing. So if you made $100,000 in profit for the quarter, your salary is $25,000, and so you're going to pay 20% on $75,000. 100,000 minus 25,000. You know, you can always change the percentages, but that's the benchmark we usually use. That's the sweet spot where you won't overpay, but you also not underpay as well. And filing a tax return can help you get a tax refund. You know, there's a big myth when it comes to tax refunds. Won't get into that, but you can get a tax refund at the end of the year or the beginning of next year if you decide to file. And as a business owner, you can write off all your expenses. And when I say all, I literally mean all. So taxes, right? As a realtor or as a real estate agent, you are now a business. You're not an individual. You're not Nicole anymore. You're Nicole LLC. You know, so you're ultimately treating yourself as a business. Every time you go out to eat, you should have a business card in your hand and you're swiping for that meal, assuming that you're discussing business during that conversation. Now, the rule to write off meals is essentially there has to be a business discussion that comes in.
It. Sorry, I was trying to.
Yeah, sorry.
Is this still live?
Yeah, let me make sure.
I think it's facing me.
Yeah, it's good now.
Sorry, guys.
All right. Yeah, so basically, there are a few things that you can write off, right? So, and a write-off simply means that it reduces your tax liability or your taxable income. A lot of people get the thing confused. I have somebody who called me, they're like, so if I write off 1,000, does that mean the government is giving me 1,000? Absolutely not. It simply means you're taking 1,000 and you're subtracting out from your gross income or your profit. And then you're taxed less money, basically, or on less money. And anything you can write off should be written off, no matter what. I understand that sometimes you apply for mortgages, which I'll get to the real estate side. You guys that are agents, there's a huge bonus that you guys really want to pay attention to at the end of this presentation. But a business expense needs to be ordinary and necessary. That's all. And ordinary means that it's ordinary for a tax firm to do advertising. Very ordinary. It's ordinary for a tax firm to have a computer. But it's very necessary for me to own an Apple Watch. You know, I have to tell time at some point in the day. It's very necessary for me to own an iPhone. It's necessary for me to write books, for me to get business cards, for me to go to Jamaica. Extremely necessary because that's how I grow my business. You know, I'm an international business. I'm not a national business anymore. So everywhere I go, whether it's China, Dominican Republic, I'm going to Cancun for a honeymoon this year, and my spouse is a business partner of mine. So guess what that is? That's a fully tax-deductible expense as a business meeting or as a board meeting, because we're business partners, we're partners. She's the CEO of the life insurance company, and I'm her partner in the company. We can easily use that company as our tax shelter, and everything I'm telling you is legal. I have IRS court cases to back up everything that I say. So I'm never afraid to get on camera or anything and say this stuff because this is stuff that I do personally. But meals, in order for a meal to be deductible, there has to be a business discussion before, during, or after the meal, whatever that means. And all you have to do, you do have to keep receipts. All you got to do is when you get the receipt, just write down the person you ate with, and just one or two words on what you discussed: real estate, sales, River North Transit. I know whatever it is, just something that's business related, and then you basically mark that in your QuickBooks as a meals transaction. With travel, all travel as a business owner becomes tax deductible because you can use the board meeting method as an S-corp owner or a business owner. Another reason why you have to have an entity is because you can't do things like board meetings. Because if you're sole proprietorship, they're like, "Where's your board?" It's like a company usually has a board of directors. An individual usually does not. So that's another reason why you should form an entity. But travel, no matter where it is you're going to China, Ghana, Philippines, Cancun. Wherever it is you're going, those are all tax deductible expenses because you're a business owner now, right? You can treat all of those things as a business expense as long as you are working at least 4 hours in a given day, right? You don't have to work weekends, you don't have to work holidays. The best time to travel is during holidays because the IRS does not expect you to work during those days, and they still let you get your write-off. Or you can declare it as a board meeting. You sit in a room for 5 or 10 minutes, draft up a document. You have your company letterhead, who attended. It could be just you or your spouse. What you talked about. Hey, we made $100,000 in sales this quarter. Just discussing business items with yourself. You file, sign, date it, and you go out and enjoy the beach. Do whatever it is you do. When I went to Jamaica this past December, that's what we did. We declared it as a board meeting. I went with my partner, who's my spouse, soon-to-be wife, and essentially we're able to write off the travel. Fees, so you guys pay MLS fees and all that stuff, that's all deductible. Dues, all that stuff is deductible. Retirement, won't get too deep into it, because I know we're running short on time. We'll leave 5 minutes for Q&A, by the way. But retirement, business owners are in the best position to save for retirement. So absolutely take advantage of that. And we can always do a follow-up or anything like that too. So let me just go in here. That's the realtor side. And then so things like home office. If you have an office, you can take the square footage method, where you basically take the square footage of the office divided by the square footage of the entire home. And if you rent, then use the rent expense. So like the rent, utilities, and all that. Add all those expenses up, and you multiply it, and that's called the regular method. Simplified method, if you own a home, that's what's recommended. You take $5 and multiply by the square footage of the home office. Health insurance premiums are fully tax deductible as a business owner. And then that FICA that we talked about, you can deduct 1/2 of it, but it doesn't mean that you actually got 1/2 of it back. It's kind of complicated to explain. And then of course, consider becoming an S corp for tax purposes. Now investors, man, I love investors. Real estate investors are one of my favorite groups of people because we can truly make a difference and not pay any taxes. Anytime you mix those two in there, I think that's something worthwhile. So if you're an investor, remember, you should be paying 0% income taxes as a real estate investor who's in it for the long run, right? So if you're in a rental property business, you're going to use the Schedule E, or if you have a partnership, you're going to use the 1065 K1, Schedule K1 basically. Now if you're a flipper, I mentioned that in real estate we pay 0% taxes. It does not apply to flippers. Flippers pay the highest tax rate among all real estate folks because the IRS doesn't want you to be flipping. They want you to hold the property, give it to somebody that's, or rent it out to somebody to provide stable housing. When you're flipping, you're kind of, not that you're messing up the economy, but you're sort of causing these price fluctuations a little. Like you're, in a way, the economy is being manipulated because of price wars and all this stuff. I read the Real Estate Outlook for 2020, and it pretty much told me that, hey, demand is probably going to be higher because interest rates went down. So more and more people are going to be buying now, you know, which is going to cause prices to probably go up. Anytime demand goes up, the prices go up too. So flipping, I'm not a big fan, but if you do flip, if you flip 1 or maybe 2, you can use a Schedule D for capital gains. Now, if you're doing 3 or more, then you're definitely in the business of flipping. And you have to use a Schedule C and you have to pay FICA tax. Schedule D does not pay any 15% FICA tax. Schedule C, you have to pay FICA tax. That's where, as a flipper, you might want to consider becoming an S corp if you fall into the Schedule C bracket. So 3 or more flips, you got to pay FICA tax, unless you're an S corporation. But as a real estate investor who's holding the building for the long run, all expenses tied to the building are deductible. Mortgage interest, property taxes, repairs, server repairs, maintenance, utilities, mileage, travel, depreciation. Now let's talk about that one. The reason why I said real estate investors should never pay taxes is because of this slide right here, is depreciation. So you can depreciate each year for 27.5 years for residential and 39 years for commercial property. Now, in 2017, the Tax Cuts and Jobs Act came out and said, wow, we can accelerate depreciation now on buildings. We never used to be able to do this, really. We could, in a way, we could do like 15-year and all that, but now, let's say appliances are usually for about 5-year or so property. So appliances, essentially now, if you spent $5,000 on rehab and appliances, you can write that off in full. First year. If you spend money on certain flooring, the roof, write it off in full. You can do what's called cost segregation and wipe out all your taxes on a real estate. I highly recommend you go through this. So let me show you an example. Let's say you bought a building for $400,000, and let's say you didn't even fix it yourself. You just decided to buy it as a value-added property. As long as you can go in the property and tell how much they spend on roof, flooring, appliances, and all that stuff, because when you're buying the building, you're buying everything. You can do what's called accelerated depreciation and pretty much depreciate my clients are doing about 80% or so of the building now. And a nice thing with lenders, they will add back depreciation to your income so that you qualify for the mortgage. Right? So I love real estate, and here's the one for real estate professionals. If you stay to the end, this is the point here. So people like myself, I cannot write off 80% of the building in full. I have to keep carrying over every year. So my real estate income will be wiped out, the profits on my real estate will be wiped out. But let's say you have S corp income. You can use that depreciation now to offset your S corp income. So if you own, let's just say a $100,000 building, and you can write off 80% of it in the first year through cost segregation, which is pretty big. 80% is pretty aggressive. So let's just say you're able to write off half of it, because you're able to individually pick out the components. You picked out the roof, how much they spent on the roof, You request an itemized listing of all the expenses in the home. So as long as you can do that, you can take the $50,000, and let's just say that your building was at a $10,000 profit. You can take $10,000, right? Now your $50,000 is now down to $40,000 because you're using $10,000 of it to wipe out the real estate. Now you can take the $40,000 and use that to offset your other sources of income if you're a real estate professional. Real estate professional is somebody who does real estate full-time, actively. So if you're a real estate agent, a contractor, myself, unfortunately, I cannot do it yet because I'm still a full-time accounting and business professional. So if you're a real estate professional, you get to use that benefit in full. This is why I encourage all real estate agents to be investors. So if you're a real estate investor that does not fall into that category of real estate professional, essentially all you can write off is up to $25,000 or so of the losses, excess losses, to offset your other sources of income. Now, if your adjusted gross income is above $150,000, you don't get any of that unless you're a real estate professional. It's very complicated, so I won't get into the details, but just know that if you own a real estate building and you're a real estate agent, you can avoid a substantial amount of taxes.
Is that if you own the whole building, or just like, what if you own a condo within a bigger?
You can still do cost segregation. It's going to be harder to do it, but you can still pick out the appliances, the flooring, there's so much stuff in a house. For example, I'm sure App Properties, let's just say App Properties owns this building. I don't know what it is, but App Properties will be able to depreciate this thing right here. And this, somebody might not think they can depreciate, these things here. So what App Properties can do is they can depreciate this component here. Of course, the TV, they'll be able to do that. These lights here, those are all depreciable components. So stuff that you can easily take in and out of a property are depreciable, including the flooring that they put on. Now, anything that's under the flooring they can't do. But let's say that App Properties, like this carpet here, for example, this is something you can easily take out of it. So whatever that was in there, you can essentially do the depreciation. So unfortunately, we don't have enough time to get through this slide. It's basically just, if I give you a 30-second pitch, if you're looking to sell real estate, I mentioned that your effective tax rate on real estate should be 0%. Even if you're selling, you can do the homeowner's exclusion. If you live in a home for at least 2 years, then basically you get excluded up to $250,000 if you're single and $500,000 if you're married. 1031 exchange, you're basically trading one property for another. So let's say you depreciated the bare bones of a building, then why not just trade that building for another building, and your depreciation in a way restarts, pretty much based off the new building's basis or adjusted basis and all that good stuff. So you can just keep trading. The best tax strategy in the world is to die, unfortunately.
Jesus. The end.
Right. Because as soon as somebody passes away, all that depreciation they got, they basically get to, not cheat the IRS, but in a way they get away with it because it's just called a step-up in basis. All your assets get stepped up to the fair market value, even if you depreciate it down to 0 on the building. So if you bought a building for $100,000 and it appreciated to $1 million, which is very well common, let's say over a 30-year time span in certain neighborhoods, and let's just say you depreciated for the first 10 years, and you're down to 0. If somebody passes away, the basis on the property is going to be $1 million. They don't have to pay taxes. They don't have to do the depreciation recapture or anything like that. So depreciation is highly recommended to look into if you haven't already. But 1031 exchange is one way to exchange one property for another without any income taxes. Opportunity zones, very big right here. There's designated zones in the city of Chicago and other cities where you can do an opportunity zone. You basically buy a property that's in a distressed neighborhood or a distressed property. As long as you take profits and reinvest it into that property and you fix it up or you improve it, you basically get excluded on your capital gains up to a certain period of time. And a charitable remainder trust of charitable LLC, I wish I had more time to talk about it. Basically, you can give your property to a charity and the property can still be paying you for the rest of your life and 3 generations after that. So you can literally take a building that you fully depreciated, you don't want to sell it, but you still want some, you want some cash flow from the building, where you give 99% of the interest to a trust, to a charity, and that charity basically owns the property, so you're giving up ownership, but if the property sells, 99% of the income goes on the charity's tax return, not yours, right? And you can set up a life insurance policy and basically have the trust be paying you out for the rest of your life. It's very, very complicated, so I won't get into the description or explanations like that. But just know that you can still be charitable, right? And still make money at the same time. Lastly, use QuickBooks to keep track of your expenses and your income. Best software that's out there right now. Highly recommended. So with that being said, I know we're out of time, but I'll stick around for any questions. Thank you guys for tuning in. Thank you, Facebook Live. We'll also download this and post it. But any questions or anything?
No, thank you. Very informative.
Thank you.
Absolutely.
That's awesome. How do I finish this?
Yeah, let me go ahead.
Finish up on